Hello, I'm Brian Resnick. I'm a senior investment strategist with AllianceBernstein, and welcome to Uncommon Capital, a podcast where we explore the far corners of the private markets and learn important lessons from professional investors. Today we're joined by Dan Pazar. Dan is an executive vice president and senior member of the investment team at Taiber, Kosmala and Associates LLC. Dan's consulting and research experience covers tactical and strategic asset allocation research, manager due diligence, spending analysis, risk budgeting analysis, and capital markets research. Prior to joining Taiber Kosmala, Dan was a senior investment professional at Lowry Asset Consulting, where he worked closely with endowments, foundations, defined contribution plans, and affluent families. Dan holds a BS in Finance from the University of Illinois at Chicago, has been awarded the CFA designation, and is a member of the CFA Institute and CFA Society of Chicago. Dan, thank you for joining me today. Tell us a little bit about Taiber Kosmala and your role there today.
Sure. Taiber Kosmala is an institutional investment consultant, consulting to primarily foundations, oddly enough, asbestos trusts, that's its own niche, high net worth families. And then we have a sister company, Tyco, which is a combination of Taiber and Kosmala, which acts as an OCIO platform for RIAs.
So an outsourced CIO platform.
Outsourced CIO platform that also has TAMP-like functionality. So in addition to everything we do on the institutional investment side and consulting side, we also go and source long-only equity managers for model delivery. We create multi-asset class models, and then we also do billing and trading for RIAs.
Wow.
So we offer them a lot of operational leverage when they want to run a business, they want to go and get clients, they want to service their clients, but they don't want to spend the money to get butts in seats to have a trader or additional admin folk.
Nice. And tell us a little bit about your role in the organization. What are the sort of things that you're involved in?
So I'm a consultant. I am client-facing. Everything that you mentioned at the intro, I research all things as well. So one of the things that we do that's a little bit different in terms of how our model is set up, anybody who is client-facing also does research. It makes it a lot easier to talk to our clients when they ask why we made a specific decision. We can really get into it, and it also helps us guide them on a go-forward basis as well.
Great. And so, what would you say is top of mind for you these days? What are the types of things that you're thinking about?
Yeah, I think we're all looking at equity market valuations, both public and private, what's going on within AI, how fast things are now changing within markets. Interest rates are a little bit higher, which is nicer. Private credit is certainly getting plenty of headlines. We have plenty of opinions on that. And there's really been a big push into private markets in general, with perhaps a new set of investors that we really didn't have 10 years ago. And those are all leading to different dynamics, and we're just trying to guide clients properly around all that.
Amazing. And so I know you mentioned at the outset a pretty wide variety of clients, from individual investors to large institutions, and you work a lot with alternatives. We focus on alternatives on this podcast. And I felt that you'd be a great person to talk to about the full spectrum of alternatives. And I want to start on the most liquid side. Actually, our last podcast, we were talking to Noel Archer about the liquid side of alternatives. And I wanted to, again, really start there with liquid alternatives and hedge funds, which are the classic liquid alternative. There was a period where it felt like everyone was writing hedge fund obituaries. Do you think hedge funds are making a comeback, or are we kind of just lowering our expectations for what they can do?
I think there was a healthy shakeout within the hedge fund complex. If you look back, this is really when I started in the industry, which was January 2nd, 2008. So it's a great time to start. But there were a lot of fund to funds. Fund to funds ultimately, not all of them, this is just a blanket statement, kind of led to some disappointing outcomes. You had kind of tepid returns, layers and layers of fees, and investors in general just started souring on that. I think the natural progression from a fund-to-fund standpoint is multi-strat. You have some really awesome multi-strats that still exist, and the ones that haven't made it, they're not here anymore. So I think on a go-forward and looking back and having the benefit of hindsight, there are some fantastic multi-strats, pod strategies or pod hedge funds where you have basically one or two people allocating capital to different managers within the same firm that all have different strategies. allocating on a risk basis. Those have obviously done well when you think about the Millenniums of the world, the Balyasnys, or then you have the systematic and really kind of AI infrastructure names like the D.E. Shaws of the world. Those have also done really, really well. So I think aside from a kind of a big group, it's definitely competitive, and a lot of the fund of funds are behind us. And I do think hedge funds now, considering some of the challenges that we're seeing from private equity in terms of liquidity, offer a pretty good value proposition.
Interesting. And what about we've seen a proliferation over the last decade or so of ETFs or mutual funds kind of replicating some of these hedge fund strategies or hedge fund premia. You mentioned systematic as an example. Do you think that, there's a place for those? And what are your thoughts on the use cases for those, ultra liquid alts, as it were?
Yeah. So I think right now there's a pretty darn good use case. If you're kind of itchy at all about the U.S. consumer, about public equity market valuations, you're unsure about the direction of interest rates and inflation, there are some pretty good kind of multi-strat replication ETFs that are out there, or ETFs of ETFs, which are constructing multi-strats that have actually done pretty well. I personally am a big fan of managed futures. That probably started in 2008 when I joined the industry. I got to see firsthand a couple clients had managed futures. When everything else was down, those strategies were up anywhere from 20 to 50%. The difficulty with managed futures can be the line item risk. And you kind of have to have the right environment for managed futures really to show what they can do. So if you think back the last 10 years when interest rates were zero and we really didn't have a lot of volatility, they just kind of bled slowly but surely, and it was death by 1,000 cuts. And most likely people got rid of them at the wrong time if they didn't have a long enough time horizon.
What I'm hearing is that there's still use cases for a lot of these more liquid alternatives. And I want to start there and talk a little bit about private markets. You mentioned equity valuations, and we can start on the equity side of privates. As you talk to your clients about private equity, what is your firm's take on that?
Selective. We tend to favor lower middle market on the buyout side if we're talking about buyout. Venture, there's always some different things to do, and manager selection is paramount. And if you look at where we are today versus 2021, when there was a lot of money flooding venture capital, there was a pretty big shakeout in venture capital. Now that you're starting to see corporations return to the venture market, maybe terms are a little bit more favorable, and the power is in the LP's hands. You also have this reset of expectations with what's happened with AI. So I think now is a better time for venture. And, if you look at venture, we're a little bit more excited about venture than we are buyout. If we're talking about buyout, lower middle market to middle market, we tend to avoid, mega cap or large, just because you have a bigger buyer base. If you have a company and you want to try to sell it, you have capital that has to be put to work, and those are natural buyers. It's also just kind of an easier value proposition when you're looking at smaller companies. Maybe they're not being operated as efficiently. And I think there's a few more levers that you can pull as a private equity manager or a GP to actually go and increase margins. You can attempt to grow revenue, which you should, and not just rely on multiple expansion. And when we look at those GPs, we really want to see some value creation and not just have a manager who is reliant on rates, coming lower over time, or the market just naturally having multiples expand.
Yeah, so let's talk about credit a little bit. We heard a lot of folks raise the alarms, late last year, almost 7-8 months ago, about impending mass defaults. We haven't really seen that in the private credit market yet. I mean, we've seen 1.5% to 2% defaults by most estimates. And I'm curious if you think that there are fundamental issues or what your feelings are around, traditional private credit or the expanded universe of asset-based finance.
So, two very different beasts. Private credit, we'll go direct lending.
Yeah.
It's catching all the headlines. It's definitely manager specific. Going back to what we were just discussing around tech and AI, there's some consternation around software names and the disruption there. No one really knows how to value those names. And then because direct lending historically is non-amortizing, those loans have to be refinanced at some point.
Right.
And we've heard some rumblings from certain private equity managers that have told us, yeah, we're holding a couple of companies as goose eggs in our portfolios, but the lenders aren't taking them over. They're just kind of resetting or kind of bringing in the spread, and we have lower base rates, and they're not taking the keys because they don't want to deal with it and show losses.
Wow.
How prevalent that is, I don't think it's as prevalent as the media is perhaps making it out to be, but you kind of see it, and sometimes where there's smoke, there's fire. But then there's other managers that we know really well that we're comfortable with that avoid some of those headline risk industries. And it's just good old boring business services and things like that. Super conservative on the underwriting from an underwriting standpoint. And their non-accruals have come up a little bit, but nothing crazy. Industry-wide on a go-forward, I think we'll probably eventually see elevated default rates just because of the amount of money that's come in and has been forced to be put to work. But is it a systemic risk? I don't think so. Everybody's talked about this, but nobody's talked about private equity. And if loans are, going to be impaired, then all the private equity is worthless.
Yeah, that's kind of one of the jokes these days is that the equity piece of that doesn't seem to be getting the heat that the debt piece is getting, especially on the software side. And so I guess as you think across, we talked about private markets broadly, touched on asset-based finance. Are there any areas that you're particularly excited about when it comes to the private markets or, areas that you'd be putting the next dollar to work for your clients versus maybe paring back on?
Looking more at asset-based finance. And going back to a concept we just talked about or touched on, most of what you find in asset-based finance is amortizing. So there's not going to be a refi risk or the same refi risk that you have within direct lending. There is some headline risk around asset-based finance when people talk about a weak consumer. But then again, it really is dependent on the group that you're investing with, because when you start talking to those groups, a lot of them are like, well, yes, but let's segment the consumer out. Let's focus on prime consumers, and let's focus on capital uses where, we're not really concerned about defaults, because this could be a home improvement. We know this person has a mortgage at 2 or 3%, and they're not going to move anytime soon. We also know how much cash they have in their bank account, how much they make. The level of detail that is received by these firms is phenomenal.
So more than just a FICO score.
It's more than just a FICO score. And when you really start getting into it, you talk about sourcing and how they originated a deal. You start to really understand the nuance from manager to manager. And then the fact that, okay, not all consumers are the same. And it's probably a pretty good cohort to lend to. Also, if you're going out and sourcing and you're buying a back book, okay, then you can do some things around structuring where it's like, okay, whoever sold it to you could put up 20% or retain a piece, but they're going to be the ones that take a first loss.
Right. And for those listeners that may be less familiar, a back book, asset-based finance is generally, buying pools or issuing pools of small balance loans. In some cases, you're working with the originator to originate them. In some cases, the pools already exist and you're buying them, which would be the back book that you're speaking of.
Exactly. And there's so much you can do. And you can be extremely selective because of how large the market is. So it's looking at things like that and trying to understand the nuance and really understanding where the protections are. We're not talking about lending to a tech company or software company and having an LTV of 35% and seeing the 65% being wiped out in one day.
Right.
And if you do have to get into a workout in asset-based finance, whether it's a financial asset or if it's a hard asset, there's something to do.
Right.
And generally speaking, the teams that are doing it have been doing it for a very long time, and they know how to work through situations.
So that's a space that's of interest. Now, as we think about one of the controversies in the market around semi-liquid vehicles, some have said that, something's broken there. Others have said that they haven't been explained properly. What's your sense of all of this noise around semi-liquid vehicles? Do you like semi-liquid vehicles? Do you use them with your clients? And, do you think there is an issue with them?
Yeah, certain asset classes fit better in semi-liquids. Amortizing loans, I think, fit much better in semi-liquid vehicles than private equity or venture capital, where it's a lumpy cash flow, and if you're forced to sell something, it's going to be a pretty heavy discount. Also, even within direct lending, a chunk of the fund is generally going to be in liquid credit or treasuries, and those tend to line up pretty well with the type of investment that's being made or originated on the private side. And it was really interesting before a lot of this started happening. There have been funds that have had higher allocations to listed or public credit. They were kind of always like, just thrown on the ground and stomped on and made fun of. And now it turns out those funds are having a much better time meeting redemption requests.
Right. When things are going well, everyone wants you to have the highest return. When things turn, all of a sudden liquidity management becomes a benefit and good foresight.
Yeah. And, at the end of the day, within private credit, whether it's direct lending or asset-based, there's really not a lot of alpha to be had, especially within direct lending. So not losing money is generating alpha at this
Right.
point.
And that's credit in general. I think you look at a lot of credit even on the public side, the alpha generators are the ones that underwrite in a way where they have less losses. So now one theme, we've been talking for a little while, and something that has come up multiple times has been this idea of manager specific, right? Whether it's hedge funds or private equity or private credit or asset-based finance or even liquid vehicles, the decisions of the manager and the skill of the manager seem to play a lot into this. And we actually just published a piece recently that showed that in private credit, about half the returns really come from manager specific actions versus the market overall. How do you pick a good manager in alts? Like, what attributes do you look for to pick a winner, and what do you avoid when looking at managers?
It's a lot of team continuity, time in the seat, managers who have been through cycles. So not somebody who's, not a firm that is just popped up more recently and is chasing loan originations. We want to see, a track record of how workouts went, because it's credit. Ultimately, there are going to be defaults. Like, these aren't, we're not in the treasury market or we're not buying agencies. And in certain cases, you see recoveries that are over par, or you see, IRRs that end up being really, really successful. And you look at the time period and when it happened, and, if it's in kind of a benign environment, then you can go back and ask, okay, what happened with this company, or what happened with this specific loan, with this pool of assets? Or if it's during the time of a credit cycle, then you can really kind of zero in and say, this group did a pretty good job managing that. We feel much more comfortable around that. And then just kind of looking at the team and looking at the headcount, especially with the amount of assets that are being raised.
Interesting. Right. Because unlike public markets where there's really just economies of scale, in private markets, you need to have people doing the work on each deal.
That's right.
And would you say the same thing applies to sort of hedge funds and private equity in terms of team continuity, time in the seat, going through different cycles?
Yeah, I would definitely say that. I think it's dependent on the strategy, depending on the hedge fund strategy you're looking at. If it's something more systematic, then it's like, all right, let's look at where you've been. Let's look at what you guys spend on R&D. How many different markets does this work in? How have you done generally in down markets? Hedge funds are a little bit different just because you can get pretty granular by the day on how everything behaved because it's marked.
Sure.
Private equity and private assets generally are marked a few times a year.
So a little bit more qualitative and team-based versus you can actually look at performance-based metrics on the and volatility and risk metrics that are more standardized on the hedge fund side.
Exactly.
And so, one of the things that I think is unique about your seat is, again, the fact that you're working across institutional family offices and kind of more traditional wealth spaces. What are some of the themes that you're hearing from clients today around alternatives?
It is so different from one to the next. We have a handful of RIAs that have been working with alts for a little bit longer, and they're starting to diversify more now away from direct lending and private equity and looking at things like real estate lending or infrastructure. Infrastructure has really come to the forefront more recently, and even more recently than traditional infrastructure or core infrastructure equities, infrastructure lending.
Why do you think that is? What's driving that?
Well, everything that we're seeing with the AI build out, and even before that, we were seeing it was the energy transition and just like the general maintenance needed on U.S. infrastructure.
Which I think, gets to your point earlier about workouts, right? If you have a team that's able to work out a situation, sometimes they end up in a better situation, even if things go wrong, whereas in public markets, you're just a price taker.
Right. And it can be very counterintuitive sometimes, and it can totally, stoke the emotional response of, oh my God, something bad happened. But then you have to remind people, we're taking risk.
Right, it's credit.
That's what we are all paid to do is
Yep.
take risk. At the end of the day, we have to take it. How do we mitigate it on a go forward is really what we're after.
Yeah, amazing. Now, you mentioned AI. How else are you thinking about AI these days?
I mean, a lot of different ways. I mean, it's kind of terrifying how fast everything is moving. We've certainly begun to adopt it internally, doing better. I guess not better, but just looking at like a mass quantity of documentation better. We've built a couple of agents. We've spent a lot of time uploading documentation that we've come up with, documentation from the IMDDA, and it's really, really awesome what you can do with it. You can upload docs, you can have it reference everything that you've uploaded, have it come up with just a really quick red flag analysis, or ask it very specific questions. Tell me about X, Y, and Z in this doc. Where do fees line up? Or there was one recently that we just did with a real estate lending strategy. And it's a newer strategy, solid name on the door, but only like 10 loans in the portfolio. The team is still coming together. And I had it do a comparable transaction analysis for each local MSA.
Wow.
And it flagged like 3 loans being like, the spreads on these are way tighter than they should be considering everything that's going on.
Wow, that's great.
And so like we haven't had a call with that manager yet, but we are, and that's just going to lead to a better conversation with that manager.
So it's like having some more employees to have a second set of eyes on everything.
Yeah, absolutely. Scaling it.
Amazing. One of the things I wanted to talk to you about, and we talked about this earlier, is your volunteer work. So I know you work with the 1 Million Degrees organization. Tell us a little bit about that. What are you doing with them?
Yeah, so 1 Million Degrees, I didn't do it last year since I moved out to the burbs, but I did that for a few years. It's through the city colleges of Chicago, and really it's anyone that's in that program shows up on a weekend and learns about banking, credit, very cursory on investments, but it's stuff that it was never really taught in
And these
schools.
are students?
They're students, yeah. Lower income students, and really just trying to get them to think about things differently. Like, this is how you build credit. This is what you need to consider if you take a loan out. This is how the interest compounds. This is what, amortization. I can only say that word. It's talking about investments like, hey, this is the S&P 500. These are the things you hear about. And it's really just trying to get them thinking about it early and not having them be scared to ask.
So just basic financial literacy that's important for building wealth and maintaining, good credit and all the things that you need to have in these days.
Exactly.
Amazing. Well, we talked about a ton of things and all wonderful. I know I've learned a lot. I'm sure the listeners have learned a lot. If there's kind of one thing that you would want someone to take away from this conversation, what would that one thing be?
Oh, man, there are so many different ways to make money. And just because you hear a headline, it doesn't mean that's what's actually going on behind the scenes. Don't be afraid to roll up your sleeves and to dig into it and ask any question you want. No question is a dumb question, especially when you're talking about different asset classes or trying to understand how the money is made and what the actual risks are.
Right. Amazing. Well, Dan, this has been such a great conversation. I can't thank you enough for joining us and really appreciate you coming in today.
Thank you for having me.
Thank you for listening to today's episode. Please rate, review, and subscribe on your favorite podcast platform. I'm Brian Resnick, and you've been listening to Uncommon Capital.